Well, good morning, everybody. I probably put good in quotes. Breaking news. Probably most of you have seen a little bit of this or heard a little bit of it. I just felt like I had to come out and address it. It's been a weird time in the financial markets once again. Um, what you see up here says Silicon Valley Bank and Signature Bank both are no more. Both banks, unfortunately, had massive runs on liquidity starting on Thursday, bleeding into Friday, and then sort of ending this weekend. Combined, these two banks had about $250 billion in deposits. Silicon Valley is the one that really made headlines. It was the 16th largest bank in the country, but it was very much focused on providing lending solutions to the tech industry, obviously Silicon Valley, right? I read that over half of all venture-backed companies had accounts with Silicon Valley Bank. So the reverberations of this for like the tech industry and the VC industry are yet to be seen, but certainly will be felt. Uh, Really, honestly, the last time we had a meaningful bank collapse was back in 2008 with WAMU. In fact, Silicon Valley Bank is the second largest bank in the US to collapse, with WAMU being the first. So, take a breath for a second. Why did this happen? I think we're still kind of figuring this out. Most of this seems to be related to the fact that banks that obviously make loans at times they have to market their positions. What does that basically mean? It means that the value of the bonds and the value of the loans that they have on their books, they have to record what the current value is. So if you look at Silicon Valley Bank specifically, I'm just looking down at my notes here because I didn't memorize this exact fact, but the company had a $21 billion bond portfolio with an average yield of 1.79%. So that means they let $21 billion and all they were earning was 1.8%, let's call it. So as rates start to go up, the value of their bond portfolio goes way, way, way down. And I think what happened was a lot of savvy people that had money with Silicon Valley Bank figured this out and decided to start pulling their money. That created a contagion, and you just had this massive fear and this big run on the bank. At the same time, the head of Silicon Valley Bank got out there and said that they needed to raise about $2.25 billion of liquidity to offset some of the withdrawals that they were seeing. So you have this like mark to market of bond positions, bad PR, and fear all leading to a massive run on the bank. And as I mentioned, Silicon Valley Bank is no more. Same thing is happening at Signature Bank. What does Signature Bank do? They had a lot of really low interest loans on their books as well. Um, a lot of really creative and structured financing as well. So, what does this really mean? Well, right now, one of the effects that we're seeing is when you see fear, you also see flight to quality, right? So, 2 year treasuries fell about 100 bips in 3 days. It's crazy. That's the biggest fall in 2 year treasuries since Black Monday in 1987. 10-year treasuries down about 50 bips. 30-year fixed mortgages are down about 30 bips. I think this morning we'll see almost 100 basis point improvement in price on mortgages. So this is the weird reality of the business that we're in, right? When there's fear, it means rates go down and it means mortgages go down and it's good for our business. So some silver lining there for us, but obviously it's concerning for the whole industry. Um, but the thankful and great part is we have this little superhero here called the the U.S. Treasury, which basically came in over the weekend. They met and decided that they would backstop and secure all of these deposits for all of the banks that are affected by this. So anybody that had money, this $250 billion is completely secure. That pulled out a lot of risk from the system. I think if they don't do this, we see a huge problem today instead of what is still a problem but not as exasperated. So thankfully this is under control. This deposit base is secured. Treasuries are better, mortgages are better, good for us. But yeah, so obviously still a lot that remains to be unpacked here. You might be curious, just I'll just kind of mention this again. what what protects the deposit base is the FDIC insurance, and that's about 250 grand for an individual and 500 grand for a couple. One of the interesting things about Silicon Valley was about 90%, 85 to 90% of their deposits were uninsured. That means people had more money there than that. So that was the big risk. People were like, oh my God, I have millions of dollars there. And all I'm going to get is 250 grand. But luckily, the Treasury has secured all of that. So this is obviously a story that's unfolding. Um, but I'm sure you're seeing it on the news. Wanted to make sure that I addressed it. Um, and yeah, a lot more to happen here. It's a weird time. I'm having some flashbacks to '08, but I think the only one of the good things that came out of the '08 crisis was that the Treasury put a lot of safeguards in place, and we're seeing the effect of those now, which is that they were able to really come in and secure everything. So everybody on deposit should be fine. Obviously, stockholders that own these banks are out of luck, as well as a lot of the bondholders that helped finance these banks. But yeah, more to follow. But right now, the focus is that, from our business perspective, is that rates and mortgages are better. So that's good news. Hopefully, we'll see more of a flight to quality, and these will continue to improve. A lot is on the horizon for the next Fed meeting. And there was initially about a 61% probability that Fed was going to bump rates by 50 bips, and now that's basically down to zero. I even read this morning that they might be cutting rates. So yeah, so we'll see how that plays out, but I think we should see more of a flight to quality and rates coming down. So, as always, though, there's a lot of volatility in the markets right now. I would just add to this little video, like, if you're floating your rates for your customers, just stop. Just lock their rates in at this point if they've agreed to it. So much volatility is going on right now. I'd hate to see loan officers miss out on any market swings that may go in their favor or against them. All right, everybody. Thanks very much. That was a lot to cover. I tried to talk fast, but hopefully that some of that made sense. Any questions, let me know. Thanks, everybody.